This is the appropriate package for the time. The economy is going through an adjustment period of heightened uncertainty, obviously, but also adjusting to the new relationships ultimately with Europe and the rest of the world. And in our judgment, it needed some stimulus. Now, it needed stimulus, not just any kind of stimulus, but something that's timely. That's why we're acting today, because we can see where we think the economy is going. But something that's coherent and comprehensive. And the coherence of it is we want to make sure that this stimulus moves through the financial system to businesses and households. So there's a variety of aspects of it that make sure that we don't just cut bank rate, but and have the banks pocket that or some of that cut, but that it goes through to households. Things that act on the capital markets, again, would go through to businesses. And we've acted in a comprehensive way with multiple instruments. We think that they're mutually reinforcing and more powerful as a result. So yes, it's a considerable amount of stimulus, but it's done so in a timely way, and we think, if we may use the term, in a smart way, a way that's going to make it as effective as possible.
What can you do? What's the message that you send to banks? I mean, we're already hearing some of them are kind of umming and ahhing about whether they're going to pass this on to their customers. What do you say to them?
Well, look, there are legitimate issues with banks. We've seen it in other jurisdictions, that when interest rates get very low, their margins get squeezed, and they try to make that up on new lending. We are their supervisor. We do know the business models of each of these institutions. We do know the results of each of these institutions. If we don't know something, we can ask them for the information. I can assure you we have a very good read on the profitability of the retail banking sectors. We have a very good read on the impact of very low interest rates. We've thought long and hard about this, and what we've done is we've calibrated a facility that offsets some of these effects, these negative effects of banks of very low rates. Offsets. Doesn't give them anything more, doesn't penalize them, okay? So it's neutral, and they can pass it through. There's competition in the banking sector here. If one or another bank is having a problem with it, their competitors will take it because this is the right way, and we will be watching how it's done.
So you'll be watching them to make sure.
Well, we'll be watching, and in the end,
passing it on.
Yeah, in the end, we watch it as a whole. We want the sector as a whole. We're not the consumer protection advocate. We're not the shadow FCA. But what we can do is see whether the system as a whole is moving this stimulus into the real economy, and that's what the economy needs at this stage.
How can you be sure that this isn't going to encourage people to hoard money? So take it out of the banks, they see that interest rates are so low, and they just don't keep it in the banks, they keep it at home in their mattresses or wherever it is.
Well, I think that issue around hoarding money is an issue when you start to go to negative interest rates as opposed to have very low but
people
zero
might
or
think,
positive
they
interest
might
rates.
think, here
well,
we
I
are
mean, you're
bank.
taking, obviously, if you're taking money out of a bank, you're taking a risk, just physical security risk, the inconvenience of doing it. And so in that regard, it doesn't make a tremendous amount of sense. It is an argument, one of the many arguments against going negative interest rates. And I will say again that one of the things we think about, one of the reasons why we would stop close to but just above zero if we had to provide more stimulus, is we do think a lot about these incentives that are in the system for individuals and for institutions. So we're only going to do things that we think actually have that stimulus. We're very confident that the steps we've taken today are going to provide considerable stimulus to not the financial system, but to the real economy.
Before the referendum, you warned about the prospect, a possibility that there could be a recession if we voted to leave the EU. Now, looking at your forecast today, there is no recession in your central forecast. So did you get it wrong?
Ed, as you know, possibility is the possibility of something turning out, growth being a little lower than the central forecast, just as growth could be a little higher.
Sure. But it is, technically speaking, it's not quite a recession, so people might just have questions about whether there was too much kind of negativity ahead of it.
No, look, it was a very straight question straight answer to a straight question. Was it a possibility? Yes, it's a possibility. Was a possibility. What we have as our central forecast right now is growth, relatively modest growth the second half of this year, modest but positive, picking up to levels below those we thought in May. Cumulatively, the difference in growth is 2.5% over the 3-year period. It's the biggest downward revision, biggest revision full stop, the MPC has ever made, and in fact the biggest in any inflation report since 1993 when they first came out. So it is a big swing, and it's a big swing after a big stimulus package. which is pushing up on growth, which is pushing down on unemployment.
So it would have been even worse, that's the point.
Well, obviously, it would have been, it would have been worse. Output would have been lower, unemployment would have been considerably higher. Look, the MPC,
but who knows?
Look, you can draw your own conclusions from that. This isn't about, this is about dealing with the facts on the ground, where the economy is going. The MPC thought long and hard about the trade-off. We are tolerating inflation being above target year 3 because we're supporting, for 2 reasons. First, we're supporting the economy, keeping activity up, keeping unemployment down. Unemployment's still rising by almost 0.75 percentage point. That's more than 250,000 jobs, even after the stimulus in our base projection. But we are leaning against that by providing the stimulus. So we're doing it for that reason. We're also doing it because we think that what's happening with inflation is that the pass-through of past exchange rates is pushing up at year 3, and then that will come off thereafter.
Just one final question. A lot of people have concerns about quantitative easing. All this money, extra money being created by the Bank of England, more is now being created, 70 billion, maybe even more money created by the Bank of England. What do you say to reassure people who are concerned about the impact on inequality, the impact on widening that gap between the haves and the have-nots?
Well, the first thing is that we're using multiple instruments. So we're not just jumping to let's do simple quantitative easing, purchase of gilts, and we're thinking inventively in a way that makes sure we get stimulus to real households, real businesses, and I can't stress that enough. That's what this package is about. The second thing is what's one of the biggest drivers of inequality? It's unemployment, and we have a slowing in this economy. We have the risk of the MPC saw the risk of a considerable increase in unemployment. It's acted against that in a disciplined way, one that respects its ultimate objective, which is the inflation target, and that's part of our contribution. Look, in the end, issues of distribution of income, of wealth, inequality, those are issues for governments. Those are issues for broader society. We are disciplined by our inflation target. We take into account some of these other effects. We've acted in a way that leans against them and acted, in our view, in a very effective way that will make a difference over the course of the next few years.
Yeah, so your message is we're trying to protect you from a recession, potentially a downturn. It's not just about the kind of twiddling different distributions.
Well, there are much bigger forces which drive inequality. We can do nothing about those, but we have to take judgments about how the economy moves through a cycle, how it responds to a shock, and we're helping this economy respond to a change in the relationship with Europe and the rest of the world in as an effective way as possible. And we're not waiting. I think the key thing is that we're not waiting to see a sharp increase in unemployment, to see an actual downturn in activity before we have the proof on the ground that we should have acted before. No, we're acting to minimize those risks, to lean against it, to improve the prospects of this adjustment, to make this a success. We're only a part of a much bigger picture here. We recognize that. But we are the bit that can act most rapidly, and that's what we've done ever since the 23rd of June.